Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the top 10 ways to invest with little money. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 10. Try the cookie jar approach. Saving money and investing are tightly linked. You must first save money before investing it. That will take far less time than you think, and it can be accomplished in very small steps. If you've never saved before, you may begin with as little as $10 every week. That may not seem like much, but it adds up to more than $500 over the course of a year. Put $10 in an envelope, shoebox, small safe, or even the cookie jar, the fabled last resort bank. Though it may appear absurd, it is frequently a necessary first step. Make it a habit to live on a little less than you earn and put the difference away in a safe place. The digital equivalent of the cookie jar is opening a high-interest savings account. They are not the same as your checking account. Number 9. Enroll in your 400 and ONIC, or similar retirement plan at work. Enrolling in your 400 and ONIC, or other workplace retirement plan may appear out of reach if you are on a tight budget. You can, however, begin investing in an employer-sponsored retirement plan with little amounts that will go unnoticed. Plan to contribute 1% of your salary to your employer's plan, for example. You probably won't even notice such a modest payment, but the tax deduction will cut the amount even further. After committing to 1%, you can gradually increase it each year. For example, in year 2, you can increase your contribution to 2% of your earnings. In year 3, you can increase your contribution to 3% of your salary, and so forth. Number 8. Open an IRA. Employer-sponsored 400 and ONICs are fantastic, but they do not provide the same tax benefits as other retirement accounts, which is why establishing an IRA is also vital. For starters, because you're opening your own personal IRA rather than going through your company, which chooses your assets for you, you'll have more investment options. Furthermore, one of the most significant benefits of an IRA, especially a Roth IRA, is the ability to grow tax-free. Your account will grow tax-free, and you will be able to make tax-free withdrawals commencing at the age of 5912. You may open an IRA with any of the best investment platforms, but if you're just getting started, we recommend Acorns. You can invest as much or as little as you want in regular investing accounts or an IRA with Acorns by setting up recurring investments of as little as $5 every day, week, or month. Number 7. Let a Robo-Advisor invest for you. Robo-Advisors originally arrived in the financial sector around a decade ago, with the purpose of making investing as easy and accessible as possible. Because Robo-Advisors eliminate all guessing, you don't need any prior investing experience. After asking you a few simple questions about your goals and risk tolerance, Robo-Advisors invest your money in a highly diversified, low-cost portfolio of index funds, mutual funds, and slash or bond funds. Robo-Advisors then use algorithms to rebalance and tax optimize your portfolio on a regular basis. There is no better way to start a long-term investment. Most Robo-Advisors charge low startup costs and fair fees based on the size of your account. All offer automated investing alternatives to help you increase your balance. The sole negative is the high cost of Robo-Advisors. Number 6. Start investing in the stock market with little money. Investing in the stock market can take several forms. It does not always mean buying individual stocks. Another approach to investing in the stock market is to purchase index funds or mutual funds. Index funds and mutual funds are stock baskets in which your little investment can buy a share of the portfolio. Index funds mimic an index, such as the S&P 500, by holding the same stocks in the same quantities as the index. They are managed in a passive manner, sometimes by a computer that just follows the index. As a result, management fees are frequently low. Mutual funds are also collections of equities in which you can invest, but they are actively managed and adhere to a set of objectives established by the firm rather than an index. Number 5. Dip your toe in the real estate market. You don't need a lot of money or even good credit to invest in real estate, a new investment category known as real estate crowdfunding. allows you to buy fractional interests in massive commercial buildings without having to become a landlord. Crowdfunded real estate investments require a higher minimum commitment than robo-advisors, for example, $5,000 rather than $500. They are also riskier investments because you will be putting all of your $5,000 into one property rather than a diversified portfolio of hundreds of distinct properties. It's enticing to own a piece of a real physical asset that isn't always linked with the stock market. Investing in real estate through a crowdfunding platform, like Robo-Advisors, incurs fees that you would not incur if you owned a building directly. Number 4. Buy a mutual fund. Mutual funds are financial vehicles that allow you to purchase a portfolio of stocks and bonds all at once, making them perfect for first-time investors. The issue is that many mutual fund providers require minimum initial investments ranging from $500 to $5,000. Those minimums can be too expensive for a first-time investor with low cash. Some mutual fund companies, however, can waive account minimums if you agree to make regular monthly investments of $50 to $100. An automatic investment arrangement is especially easy if you can execute it through payroll savings. As with an employer-sponsored retirement plan, you may usually set up an automatic contribution through your payroll. Simply inquire with your Human Resources department about how to get started. Number 3. Money market mutual funds. Money market mutual funds invest in a diverse portfolio of fixed income securities with short maturities and low credit risk. They usually pay a low interest rate, but unlike other forms of mutual funds, there is a limited chance of capital appreciation. This type of investment gives a lot of liquidity, and because of the types of investments they make, they are considered to be quite safe, with a low risk of losing money. They are not, however, FDIC insured, unlike savings accounts or CDs. Money market mutual funds are best used as a safe haven for cash that you want to have on hand in case of a significant purchase or another investing opportunity. Number 2. Fixed annuities. Fixed annuities are a prominent type of annuity contract used for retirement planning, but they can also be useful for medium-term financial goals. Insurance and financial service providers can sell fixed annuities, which guarantee a rate of return for a set length of time regardless of market conditions. The life of an annuity is separated into 2 stages: accumulation and payout. In the first, you make periodic payments into your annuity and earn interest, which raises the tax-deferred value of your account. The payout phase can be a single lump sum payment or a series of recurring installments over time. Although inflation can diminish the value of a fixed annuity, many companies offer cost-of-living adjustment riders to help your annuity stay up with rising costs. Number 1. Invest for the long term. Investing small quantities of money each month may appear insignificant. However, you could have amassed a sizable pot over the course of 20 or 30 years. If you intend to invest your money for decades, you can afford to take on more risk than someone who needs access to their money in the next few years. Investing is better for the long term since the longer your investment horizon, the more time you have to wait for prices to rebound. Investing in a pension is an excellent way to accomplish this because it qualifies for government tax breaks, as well as supplemental contributions from employers for those in workplace pension systems. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.